All right, it sounds great. Why don't we begin? Thank you once again for attending. My name is Stephen Primo. I am the president and founder of Specialist Trading. See a lot of people who have attended my presentations before, but for those of you who haven't and are unfamiliar with Specialist Trading, excuse me, we are an educational company. We provide, we believe, your premier education for trading virtually all of the markets, and most especially the Forex markets. Now, I have been trading just a little over 35 years now, going on 36 years, virtually all of the markets. I started out as a specialist on the floor of the Pacific Stock Exchange. I was a specialist for 9 years. I left the floor in the 90s to manage money and to trade my own account. And I virtually traded everything from stocks, E-minis, to the Forex markets. And I've picked up a lot of great information, things that can help you and that can hopefully elevate your trading. This is what we do at Specialist Trading. All of the things I've learned in my 35, going on 36 years, we accumulate into strategies, into courses, into tips, different things, once again, to take your trading to the next level. So you won't have to actually stick around for 36 years to gain all the things I have. You'll be able to understand them and be able to use them within a matter of weeks to a month. Now, what we're going to be speaking about today are new and simple ways to use candlesticks. And this is actually going to be part one of the presentation. I'll complete the second part in next month's webinar. Now, I know a lot of Forex traders love to use candlesticks, and most people use them, in our opinion, incorrectly. I'm going to show you how we use them at Specialist Trading, and then I'm going to show you a new and, we believe, a highly profitable, or at least putting the odds in your favor, a new way to use the candlesticks. And you can start applying this technique as early as today if you'd like. But before we begin, as always, I ask that you please take a moment to view our disclaimer. I'm going to show you a lot of information today, and once again, concerning the candlesticks and this new, different way in which to use them. But please remember that we can in no way guarantee that any of the results I'm about to show you will be repeated in the future. So as you're taking a moment to view the disclaimer in front of you, once again, if you've attended my presentations, you know that I like to take the questions and answers at the very end of the webinar. So this way we have more room to work with and more time to spend on slides and showing you a lot of this information. So I promise I will be taking the last 5 or 10 minutes to answer any questions. If you run out of time, I'll leave you with an email address, my email address, or a phone number where you can contact us at Specialist Trading and we can answer any questions, okay? Now, another way in which to get your questions answered basically is to become a member of Specialist Trading. Remember, my goal is to teach you how to trade with the Specialist Edge, and this is what all of my members receive. The same edge that turned my way of trading around will hopefully turn your trading around. So hopefully you can become a member of Specialist Trading, and we're going to give you a lot of information on how you can take advantage of a really great discount in today's presentation. But for more information on us, FX Street has provided us with a microsite. If you see here this link, you can simply click that on. I know it's a little lengthy, so we've shortened it to this yellow, smaller link right here. So if you would like to copy this down, what it'll do, we'll show this also at the very end of the presentation, but this link will take you to our microsite where it gives you more information on Specialist Trading, information on me, and also information on course descriptions. All right, with that said, with that out of the way, why don't we begin? Remember, what you're going to learn today is a new different edge for using candlestick patterns. This is engulfing pattern number +1. And then we're also going to show you some current examples that go as far back as 6 months and examples that go as far back as maybe a couple of days in all different time frames and different directions. So once again, if you have any questions, kindly wait till the end of today's presentation. All right, so the pattern we're looking at, the main pattern, is a candlestick pattern. And most people are familiar with candlesticks. They use them in a lot of their trading. But for those of you who are unfamiliar, let's just do a brief overview of what a candlestick pattern is and the way we use it at Specialist Trading. Now, we're looking at engulfing patterns. This is the really important pattern. Most people use this pattern, and most people are familiar with it. But once again, let's just give a brief overview. The reason why we're talking about engulfing patterns is because there is a high probability that the trend will continue in the direction of the engulfing bar for the next 2 to 5 bars. So this is why it's such a great pattern to implement. Many times you'll see an engulfing pattern on a 5-minute time frame, and other times you'll see it on a monthly. It doesn't matter. There's a real high probability that the trend will continue in the direction of the engulfing bar or the second bar in that 2-bar pattern for the next 2 to 5 bars. So if you're looking at daily bars, it'll be for the next 2 to 5 days. If you're looking at hourly bars, it'll be for the next 2 to 5 hours. Now here's an example of what we mean by bullish engulfing patterns. This is the way we use them at Specialist Trading. We're not concerned, here are the 2 bars here, And the second bar's range from open to close totally engulfs the previous bar's range from open to close, which is the opposite. So in other words, you need kind of a reversal. You need a downward or dark body totally engulfed by an upward or light body. But we're not concerned with engulfing the range, in other words, the high and the low. We are only concerned with the range from open to close engulfing the downward range from open to close. Okay, so that's all we're concerned about in a standard engulfing pattern, bullish engulfing pattern. Why? Because this is giving us a high probability that we're going to be heading up for the next 2 to 5 bars, okay, regardless of the time frame. And the same thing works if we're looking at a bearish engulfing pattern, which is just basically a negative day engulfing a positive day, the prior day, where we're looking at the range, the open to downward close, totally engulfing the previous day's open to upward close. But the range, remember, not the entire range from high to low. We're not concerned with the wicks or the candlesticks. We're only concerned with the bodies of the candlesticks. Okay? If we have this bearish engulfing pattern, there's a high probability that the trend will go down within the next 2 to 5 bars regardless of the time frame. Okay? Now that's your standard basic bullish and bearish engulfing patterns. And remember, we said there's a real high probability that the trend will continue. Here's an example going back to an older chart of the British pound. We see here that we have a bullish engulfing pattern. And look what happens. In the next 5 bars, we go up until we have a bearish engulfing pattern. And then look what happens. For the next 3 bars, we go down. And then we have a series of bullish engulfing patterns next to each other. So guess what happens? We go up for the next week and so. And so you see how strong this pattern is and how it can really help us in finding out what the direction of the trend is. Now this still works in a different time frame. Here's a Canadian dollar on hourly time frame. Here's a bearish engulfing pattern. Guess what happens? The next 3 bars are lower. Here's another series of bullish engulfing patterns, and we continue higher for the next roughly about 10 bars until we finally get to a bearish engulfing pattern again, and then we head lower. So do you see, even though this isn't guaranteed, this is not going to work 100% of the time, there's a very high probability in using these engulfing patterns. Excuse me. Now, what we're going to talk about is heightening the probabilities for success with the engulfing patterns. This is our proprietary technique which we employ at Specialist Trading. It's called the Engulfing Pattern +1. All right? So what exactly is this? Well, we incorporate the standard bullish engulfing pattern. As you can see here, this is your standard bullish engulfing pattern. We have an upward day from open to close, totally engulfing a downward day from open to close. So that's your standard bullish engulfing pattern +1. So we are also engulfing the range from open to close of 1 more bar. All right? So you see here we have the standard bullish engulfing +1. Now, as the former rules state, we're not concerned with engulfing the range from the high to low. So the same rules apply. We're only concerned with engulfing a body from open to close range. All right? So even though we did not engulf the entire high of this particular day, it does not matter. We only want to engulf the movement from open to close. Another thing to remember is that it does not matter if this is an up day or a down day. Now, in this particular example, it was an up day. It doesn't matter. This could just as easily been a down body. All right? It does not matter, a dark body. And then lastly, the more engulfing patterns you have, the more +1s, +2, +3, even +8 or +10, the higher the probability it will extend in that direction. So we're not just looking for +1. I will show you examples of bullish engulfing patterns +8 along the way here. Now, once again, this is a very high probability pattern here that you're going to be heading upwards. And the same thing, reference works to the downside. We have our standard bearish engulfing pattern where we have the downward day from open to close, totally engulfing the previous day's up day from open to close. All right? But a +1 would mean we engulf 1 more day. Now here, we're engulfing once again just the open to close range. We are not concerned with engulfing the top or low. This is where most students have difficulty. For some reason, they've been taught that engulfing patterns mean you have to engulf the entire range. We're only concerned with engulfing the open to close range. And then point number 2, we're not interested in whether this was an up day or a down day. In this particular instance, we are. In order to have the bearish engulfing pattern, we have to have a downward day engulf an upward day. But the +1 and other plus days after that did not matter. It doesn't matter whether they're up or down. And I'll clarify that by showing you some more examples. Okay? So this is our proprietary pattern This is what we're going to cover in part one of this two-part webinar here, the next one to be happening in February. So this is the one we are talking about today. It's a bullish and bearish engulfing pattern plus 1. All right, so let's look at some examples now. We're going to look at some examples going as far back as 6 months. We'll also go back, maybe a couple of weeks. But we're just going to make sure that you understand this fully. So I'm going to show you a lot of examples. And then remember, if you have any questions or if something doesn't make sense, just wait till the very end. All right, let's start out by looking at daily bars, okay? I know most people will trade daily bars, so let's look at and see how this transfers over very easily onto daily time frame. This is going back just a couple of months ago in the dollar-yen. As we see here looking back, we really didn't have much of a range at the end of November going into the middle part of November. We were kind of ranging from top to bottom, top to bottom, top. But as we realize here, what do we have? We have a bullish engulfing pattern right here. All right, this upward day totally engulfs the previous day, which is downward. But at the same time, if we look at it, we see that we not only engulfed the previous day, but we also engulfed 1, 2, 3 other days as well. So this is a bullish engulfing pattern plus 3. Right there, the dollar-yen, roughly about 80, was telling us there's a high probability we're most likely going to go higher. This was at the beginning to middle of November. And look what happened. Within the next month, we all see how well the dollar-yen went up. This is without the aid of any news, without the aid of being in any chat room, without the aid of trying to decipher any economic reports. This is just listening to the most important thing, which if you've attended my presentations before, I always state that the only thing you should be listening to and following is the chart in front of you. That's the market you're following. Because it really tells you what it wants to do. There's no need to listen to variations on news or be involved in a number of chat rooms or worrying about different indicators or resistance, support and resistance. Everything is really right here in front of you. So the market gave us a great clue that there was a high probability of a dollar-yen going up higher on a daily time frame. And as we see here, we went up higher right off the bat, and then we kind of stalled at these levels. Well, guess what? While we were going sideways, what happened? We had another bullish engulfing pattern. Plus 1, 2, 3, 4, 5, 6, 7, 8. So this, and on this little stall here, once we had a nice 300 pip gain, a lot of people could have said, well, it looks like we're topping out. I read some indicator or some Forex guru was telling me that, we're topping in the dollar-yen. We should probably exit or go short. Well, not according to the market. Remember, we only want to listen to the market. And the market was telling us, nope, there's a bullish engulfing pattern here, plus 1, 2, 3, 4, 5, 6, 7, 8. So this is telling us that the market is most likely going higher. And as you can see here, it continued to go higher. This is the current chart up until last week. How about the Canadian dollar? Now, we're going back a little bit further here. This is going back towards the end of the summer. As you see here, we had a bearish engulfing pattern. This downward day totally engulfed the previous day's upward day. But if we notice, we not only engulfed the previous day, we engulfed 1, 2, 3, 4, 5, 6, 7, 8. So this was a bearish engulfing pattern plus 8. This was at the beginning of July going into August. So right there, the market, the Canadian dollar on a daily time frame was giving us a great clue that it wanted to go lower. So if you were thinking about going long, this is where listening to the market really pays off. If you were in some chat room where they said go long the Canadian dollar, or you subscribed to some news service that said the Canadian dollar looks very good to purchase here, I would kind of sit back and take it with a grain of salt, because the most important reference, which is the market itself, was telling me most likely we're going to head lower. And as you can see, look what happened towards the end of the summer going into the fall. The Canadian dollar went down roughly about 500 pips. All right, so let's look at weekly bars now. We see how well this transferred over into daily bars. How well did this work in weekly bars? Let's say you're an investor and you'd rather fine-tune this to tell you what the trend is going to be on a weekly time frame, and then you could go down maybe to a daily time frame to trade. All right, so I know a lot of people like to trade that way, so let's look at some older weekly bars. Now, for weekly bars, since there aren't as many as examples, the further out the time frame you go, you're going to get less and less of these, so we'll have to go back a little bit further. So this is going back to the beginning of the year or so. We look at the Swiss franc on a weekly time frame. Now, as we see here, we had a really nice run up and then a really nice run down here in the Swiss franc. At the end of March, beginning of April, what did we have? We had a bullish engulfing pattern plus 1. And as you can see, this was the market telling us most likely we're going higher, and we had a nice 700 pip gain. Now, right at the very top of that really nice trend to the upside, what did we have? We had a bearish engulfing pattern plus 1. And then as you can see here, that's where we have it walled off in the brackets, a bearish engulfing pattern plus 1. So the market at this time was telling you, if you're long the Swiss franc on a weekly basis, or if you're thinking about going long, I would kind of step back now because most likely the trend is going to change to the downside. And it did. We went down 500 pips in the next 2 or 3 months. If we want to go back even further, let's look at a weekly chart going back to 2011 of the euro dollar. Okay? Now, as we see at the very bottom here, we had a bullish engulfing pattern plus 1, 2, 3, 4. We had another bullish engulfing pattern plus 1, 2. And then, as you can see, we went up 1,000 pips in that very beginning of 2011. But then things seem to stall a little bit, and this is where it gets difficult, and I want to make a point here that many times, as with any other type of pattern or any other type of trading methodology or technique, you'll go into some whipsaws. And that's okay. It's just, remember, this is not a strategy. That's one thing I want to point out. This is just a technique for finding the trend or being in sync with what the market wants to do. It's not a real strategy. So you will find whipsaws even in this. This is why we say it's not 100% guaranteed. As we see here, we had a bearish engulfing pattern plus 2. So right at the very top, in roughly spring or beginning of summer of 2011, the euro dollar was topping out on a weekly basis. The market gave us a great clue. So look what happened. We fell out of bed just a little bit, but then we kind of went sideways, and the market gave us a bullish engulfing pattern plus 1. All right. So at this point, you would have said, well, maybe that's the end of the downward move. I should start to look for buy setups. All right. And this is where it can get a little whipsaw. Well, really nothing happened. As you see, there were really no nice trend moves either to the upside or to the downside. We continue to go sideways until right here, where we had a bearish engulfing pattern plus 1, 2, 3, 4. Remember, as I stated at the beginning of the presentation, the more days you have on top of this, the higher the probabilities that there will be a move in that direction. So even though a bullish or a bearish engulfing pattern plus 1 is a high probability signal, a bullish or bearish engulfing pattern plus 4, 5, 6, 7, or 8 is even better. So as we see here, we had a bearish engulfing pattern plus 1, 2, 3, 4. And then 1,200 pips to the downside. Okay? So this is a great, great trend technique. This is not a strategy. I see some people may be thinking about, well, where would I enter? Where would I place a stop? Once again, as I stated just a few minutes ago, this is just a technique for finding the trend. All right, so let's look at monthly bars now. A lot of you will be saying, well, okay, Steve, I don't really trade dailies or weeklies. I'm more of an investor. Does this work for monthlies? Sure. You see examples just the same way. The only trouble is, once again, the more longer out of a time frame you go, such as weekly or monthly, the less signal, so you'll have to go back in time a little more. Well, let's go back to the Australian dollar, going back to 2006 into 2009. As we see here, we had a really nice run-up in the Aussie dollar, going back or about 4 years, all the way up. It was continued to go higher. As early as 2006, we had a bullish engulfing pattern plus 1. Then in the end of 2006, we had another bullish engulfing pattern plus 1. All right? So this was telling you right here when we were kind of going sideways that there's most likely going to be a trend continuing to the upside. And as you can see, it continued to go higher. And all the way it went higher, we continued to see these bullish engulfing pattern plus 1. All right? So it was telling us that even though we had kind of a downward move here in 2007, at the end of this two-bar pattern, we're still going to be going higher. And you can see we did. We went up a total of 2,000 pips in roughly that 3 or 4 year time frame. But what happened right here at the middle portion of 2008? We had a bearish engulfing pattern plus 1. So had you been a long-term investor in the Forex markets, or had you been using this as a trend tool, at this point, you would have said, you know what, if I'm long the Australian dollar, I've had it in my portfolio, I've been doing really well, I think I'm going to tighten my stops. Or perhaps if I had, a large position, maybe I would sell a portion of it, or half of it, or maybe even all of it, just to take some profits off the table. And you would have been doing the right thing had you taken a course there, because remember, we only want to listen to what the market is telling us. And I'm sure right here at the top, just as in any market, most people were as bullish as could be. But if you were savvy enough to know how to listen to the market, you would have said, no, this is a bearish engulfing pattern plus 1, which is a high probability signal telling me the trend is most likely going to change to the downside. And as you can see here, at the end of 2008, it was a terrible year for the Australian dollar. Gave back all the gains it had made in the previous 3 years and more. But you, being the savvy investor and the member of Specialist Trading who knows these techniques and tips that we teach people like this, you would have not come out scathed at all. You would have actually probably would have made money because we had a number of strategies that would have gone short the Australian dollar. Let's look at a monthly chart of the Canadian dollar now going back to 2010. As we see here, we had a downward move followed by a nice bounce to the upside. Well, how could we have taken advantage of that? Looking back, we have a bearish engulfing pattern +1. Okay? We have another bearish engulfing pattern +2, and then we kind of fell down 900 pips. At the very low, look what happened. We had a bullish engulfing pattern +1. So, seeing that, things worked out very well, and we went up 600 pips. So this was a really nice move. We had a nice move to the downside in the Canadian dollar on a monthly time frame, and we had a nice move to the upside, 600 pips following that. Now, what if you're an intraday trader? I know a lot of you will say, well, Steve, I'm a day trader. I don't even look at anything past an hour chart or 4-hour chart. That's fine. Let's look at a 15-minute chart in the euro. And this was, I believe, not even 2 weeks ago. I believe it was on the 10th of January, just last Thursday, or the week before last Thursday. The euro dollar had a really nice move to the upside. And a lot of people would have said, boy, I wish I would have known. I wish I would have had some advance information, or maybe some chat room could have helped me, or some news item could have helped me to go long. That's a nice move in the euro, and I totally missed it. Well, if you knew how to listen to the market using this tip and technique, you would have seen that right down here, before we even took off, when the euro was going sideways, we had a bullish engulfing pattern +1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Remember I stated that the more days you're engulfing, the more ranges, the higher the probability of the move. So before the euro even took off, it was going sideways, literally sideways. You were getting a great, great clue from the market itself, not from an outside source, but from the market telling you you should most likely get ready to look for a strategy telling you to go long the euro dollar. Look for buy setups. All right? And whatever you do, most likely do not go short. I don't care what the news is. I don't care what they're discussing in some chat room. Look to go long the euro. And as you can see, you had a really nice move to the upside in the next couple of hours, 150 pips. So a day trader could have really taken advantage of this. How about the British pound? And this is going back to the 7th. This was, I believe, a couple of weeks ago, the 7th of January. We were in a pretty nice and sustained downward move. How could we have taken advantage of this with this technique I'm teaching you today? Well, here's the technique. All you would simply do is look for the bearish engulfing pattern. And here's a bearish engulfing pattern +1. Okay? And guess what? 95 pips to the downside within the next 3 or 4 hours, as you can just see. It's very simple. The easiest thing to notice is that you have a standard bearish engulfing, and then you're looking for one more range, body range, from open to close to engulf. The more body ranges you can engulf, the higher the probability that we'll head in that direction. Now, I want to share with you something I did the last time I gave this presentation. I gave this presentation, I believe, about 6 months ago for FX Street, and I noticed on, I believe, a monthly chart pattern that there was a tremendous bullish engulfing pattern +2 or 3 in the euro yen, and we can all see, we all knew what happened in the euro yen this past year. It's gone straight up. So this was a fantastic clue that I gave for free to all of the attendees today. I want to inform you of another engulfing pattern +1 that is currently unfolding. So you may want to keep an eye on it. This is in no way a recommendation or a signal in order for you to trade. I'm just telling you this is for educational purposes only to spot. Here's a weekly chart of the dollar Swiss franc. Okay, now currently the Swiss franc is in a downward mode on a weekly chart, but it's kind of been going sideways. And as you see here, we have a bullish engulfing pattern. This was at the very end of the last year of 2013. We had the week closed with a bullish engulfing pattern +1. So this is most likely telling us to get ready to go long the Swiss franc on a weekly basis. Remember, this is not a strategy. It's just a trend filter. But you must go long using some type of strategy that has, entries, exits, and some type of a structure to it. Well, nothing really has happened since then in the 2 weeks in the beginning. We've had a nice little rally here, but nothing tremendous, okay? But in this last week, this was at the close of last week in the Swiss franc, guess what? We now have a bullish engulfing pattern plus 1, 2, 3. So we've gotten two signals from the market telling us that most likely we're going to get a high probability upward move in the dollar Swiss franc. And then once again, I did the same thing about 6 months ago in the euro yen, and this worked perfectly. I'm not guaranteeing that this will work, but just keep track of this now, and perhaps maybe next time we get together we'll speak about this again and see how well, if it worked or not. But this is a great clue that the Swiss franc is giving us, telling us that most likely this little downward move we've had lately is over, and we're going to go up. Now remember, this can all change. We can have a downward week, and now we would have a bearish engulfing pattern, possibly plus 2 or 3 or 4. So you must keep track of this to see if there are any changes happening. Now one more thing I want to state that may be pointing to a really nice move to the upside in the Swiss franc is if we go to a different time frame. If we go to a monthly time frame, this is the current monthly time frame. As you can see here, this is the end of the month of December in 2013. This is current. What do we have here? Well, this is at the close here. And so this hasn't, or actually this is at the end of January. So we haven't completed this particular candlestick right now. But if we continue to rally in the Swiss franc and end at this high dotted blue line or even higher, we will have on a monthly basis another confirmation using this technique telling us that we have a bullish engulfing pattern plus 1. And if we go even higher, we could possibly engulf this day as well. So these are two different time frames, two totally different candlestick charts here, both giving us real high probability clues that the Swiss franc may be entering into a nice upward move. So something to watch. As with all of my presentations, we're not just trying to sell you and tell you to become a member. We also want to give you information and things you can use. So this is something you can probably use. Just remember to watch, and best it would be to paper trade it to see if it goes in an upward direction. Now, points to remember. As I stated at the beginning, and I know a lot of you may be thinking, well, Steve, where do I enter using this? Or where do I place my stop? Those are things that apply only to a strategy. Stops always have, or I should say strategies always have stop placement. They always have entry and exit rules. As you notice, I didn't mention any of those things because this is not a strategy. This is a pattern that is best used as a directional tool. So in other words, the way you want to use this is you want to look for these bullish engulfing patterns plus 1, plus 5, plus 8. You want to look for these, and once you find them, then whatever strategy you're using, whether it's one of mine or one of yours, look for signals in that direction. So if you see that the Swiss franc starts going up very strongly, well, obviously you're not going to short it. You want to use a strategy that will apply some type of entry to go long. So that's what you should start doing once you see that the trend has gone in that desired direction. Remember, you can apply this to any time frame, any direction. So if you want to experiment, look with this on a hourly chart today. See if you find any on any currency pairs, or you can go to weekly bars or any time frame. Okay. Also, engulfing patterns plus 1 are more prevalent in smaller time frames. I see here we had rhyme frames. It's a good rhyme, but it's a smaller time frame. Thank you. In smaller time frames, so you're going to see a lot more. So if you're really wanting to trade using these for trend direction, look for smaller time frames, and you'll see a lot more. If you're going and applying them to weekly or even monthly, you'll still see them, but you'll find far less. It's just because there's not as much movement. Okay. All right, so let's recap. What did we talk about today? I gave you one of the best edges that we have here. And we have literally tens, if not hundreds, of edges and tips and techniques that we teach at Specialist Trading. And this is just one of our better ones that I'm giving you and sharing with you today. This is Engulfing Patterns plus 1. And I showed you exactly how to use it and how to find it and how to implement it as a trend directional tool. Okay? And then we gave you a lot of examples and showed you some current examples, especially in the Swiss franc, as how it may apply to a nice rally coming up. Now, in our next webinar in February, possibly I believe in about another month from now, I'll give part 2 of this presentation. This is our second best edge. These are bull-bull, bear-bear patterns. They use candlesticks as well, but I'm going to show you another pattern which I believe is even a higher probability pattern for finding the trend. And that will be in next month's presentation. This is edge number 2, and I'll show you current examples using those as well. Now, as we come towards the end of the close here, I just want to remind you that we are an educational company. Here is my website. As you can see, we give courses to all of our members in stock trading, e-mini trading, as well as Forex trading, as you see right here. So we have 3 different courses, 3 different categories for your style of trading. Each category, each different market comes with upwards of 10 specific different strategies for trading those markets, anywhere from intraday strategies to weekly strategies to swing trading to quick overnight trading. So if you become a member of Specialist Trading, you're going to be privy to all the things, once again, that I've learned and accumulated in my past 36 years of trading. Now, one of our best courses, probably our premier course for trading the Forex markets, is strategy number 5. It's our Forex Swing Trader courses, which does incorporate the engulfing candlestick. So a lot of people were saying, well, Steve, how would I use this bullish engulfing pattern plus 1 to go long, or where would I enter? Well, you would need a strategy to trade that, and that is exactly what strategy number 5 does. Should you want to become a member, you get immediate online access once you decide to sign up. This comes with detailed online videos, 10 videos altogether. I teach you exactly where to enter, exactly where to place your exit, and where to place your stop. And this is not only for our standard versions, but for conservative as well as aggressive traders. So you can pick whichever style you'd like to use. This comes with 1 year of trade signal alerts. And so these trade signal alerts are for daily bars. So in the past 2 years, if you had taken all the signal alerts that we provide for our members, you would have been up roughly about 130% in your account. That's based on that's based on a $25,000 account. We provide you with PDFs of the rules, so you can download them and print them out and learn at your own time. And then you also get my personal email address. You can have access to emailing me whenever you'd like, and so you can ask me questions in the middle of the night, or why there was no signal, or why there was a signal if you don't seem to be understanding the process. Now, this is a tremendous, this is our proprietary, or I should say our premier strategy for trading the Forex courses, and once again, it's up over 130% in the past year if you just took the signals alone. You would be paying for the course tens, if not 20 times over at the low price of $5.95. We're reducing that even more for the attendees at FX Street down to $3.45. But this is for a limited time only, so if you're very interested, please contact us about trading engulfing patterns with strategy number 5. And remember, if you want more information on anything associated with specialist trading, about myself, or about any of our courses going into description, please go to this link here that FX Street has provided for us. This is the microsite where you can get more information about me and about our courses and our strategies. Once again, it'll take you to this page, and you can click on this little link here for course descriptions. All right, as promised, we are at the question and answer portion. Thank you so much. I know a lot of you people wanted to ask questions, and I appreciate you waiting. Let me see if I can answer some of them. But just once again, if you have any questions, you can go to our sister site. That's ProTraderStrategies.com. What they do is they basically sell our individual strategies. Rather than the full suite of 10 courses altogether, you can buy our individual courses, such as strategy number 5. If you have any questions, you can contact our VP of Operations. That's Brett Marsh at BrettM@SpecialistTrading.com, or you can call us directly at 310-844-7220. All right, let me see if we can get some questions here. Let me open up the question box and read them. I'll go back to the beginning so I don't miss anyone here. This is from Brian. Brian says, interesting, how do you time your entry? Well, remember, Brian, I guess I answered that within the course. This is not a strategy. All of your entries and all of your exits and stops are all given within the course, though. Those are all. We have proprietary entries for trading conservatively. We have proprietary entries for trading aggressively. Also, we tell you how to, you asked also about your lot size with the probability, plus 1, 2, 3. Where would you place your stop? So these are all questions you're asking. And once again, Brian, these are all answered should you become a member. I just can't give away that information because, once again, those are proprietary things that we've developed with the course. And people who have already paid for the course, they wouldn't appreciate it too much if I were giving away the rules for free, though. But I would, if you're really definitely interested in using this technique with the engulfing patterns, I would urge you to take advantage of this great discount we have for $3.45 in conjunction with FX Street. This is the next question from Jack. Jack, do the yen, the daily, the last few days have bearish engulfing plus pattern? That's a good question. You know what, Jack, I'll have to check, though. I don't have access to the charts right now, so I don't know just off face value. But I'll check, and you can email us, and we'll email you back, Jack, and we'll let you know. But that's a good. Once again, you know the rules now. You can go and find. Just remember that if we're looking at a bullish or a bearish engulfing, all we want to do is make sure that that's a 2-bar pattern, that the second bar in a bullish engulfing pattern only engulfs the prior day's open to close downward range. All right, we're not concerned with the high or low. We're not concerned with the candlesticks, the actual wicks. We're only concerned with engulfing the range. So once you have that down, you can see for yourself if it's a bullish engulfing +1, +5, +8, and the same instance if it's a bearish engulfing pattern as well. Ivo, it's asking, didn't tell him it was most likely to continue 2 to 5 bars. Well, yes, when you have this standard bullish or bearish engulfing pattern, the probabilities say that it's most likely to continue for next 2 to 5 bars. But when you have the bullish or bearish engulfing pattern +5, +8, even though we don't have any exact numbers, it's a higher probability that's going to extend even longer, as you saw in those examples where we gave you the euro dollar was a bullish engulfing pattern, I believe +8 or +10. The more you are engulfing, the higher the probability that it's going to be an extended move, more than just 2 to 5 bars, okay? So I hope that answers your question. Yes, this is just a trend bias. This is a great tool for using as a trend bias. Once again, this is not a strategy, okay? And thank you, James, for the spell check. I appreciate that. Boyke asks, is this good? Hi, Boyke. Is this good for all markets? Yes, it is. I tend to find, I mean, you can see this in stocks, you can see this in the E-mini. I tend to find this much more prevalent in the Forex markets, though. There are specific tools and specific techniques that we use at specialist trading that work much better or more prevalent in different markets. And this particular method for finding the trend bias works much, much better in the Forex markets. I don't know why that is. It must be because of the added money flow of capital influx in and out of the markets on a daily basis. But you see this a lot more, and it's a lot better probabilities and working in this particular market. So I would really use it mainly on the Forex markets. Okay. Let me see if you have other questions. Ray asks, what technique do you use to keep you from trading the whipsaws? That's that's really great. We have other techniques. We use one of the things which we also incorporate, not in this particular technique, but which helps us, is a 50-period simple moving average. And that's a webinar in itself. I've talked about it before. This is probably our most important edge we have at specialist trading. And we call it the buy-sell line. And all it is a 50-period simple moving average, which means that if you are above the 50-period simple moving average, you're only going to be looking to go long. And if you're below the 50-period simple moving, you're only looking to go short. So if price is kind of oscillating back and forth, it will keep you out of those whipsaw moves. Remember, this is just an indicator telling you what side to be on, buy or sell. It's not a strategy, as people asked earlier. So if you have a 50-period simple moving average and price is above, it does not mean simply to buy at the market. It means that you must now, as I stated earlier, look for some type of setup to go long. You must have a strategy that has rules that incorporates entries, stops, exits, that will tell you when to get in, because you're above the 50 period. If you're below the 50 period, you'll only go short, and you'll look for a strategy to tell you to go short. Now, when price is whipsawing, usually it's whipsawing from being above and below, going back and forth on that 50. So with this great tool, the buy-sell line, many times it keeps you out of that. That's probably the best thing we use to keep us out of whipsaw. We also have other techniques, our confirmation technique for entry, which keeps us out of whipsaws as well. So there's a lot of things, but unfortunately, those are things that take length in another webinar, and they're part of our classes as well for all of our paying members. But if you incorporate that 50-period simple moving average and only look to buy signals when it's above, it will keep you out of a lot of that whipsaw. Okay, I hope that helps. When is your chart daily close? Okay, from Jano asks, when is your chart daily close? We use the U.S. hours. Okay, so we basically go to, when we're looking at the Forex markets closing, it's 2 p.m. Pacific time. I'm on the West Coast, so it's 5 o'clock Eastern time, 2 o'clock Pacific time. Okay, so that's what we're looking at when we look at our 24 daily bar charts. James says, when I saw that all patterns had a gap opening, what does this mean? Well, we're not concerned with a gap. A gap opening just means that it usually was something from the weekend. Many times when you see gaps, it usually happens when the markets are closed for the weekend, and then some news or something happens over the weekend. You'll gap higher or lower. We're really not concerned. Once again, it doesn't matter if there's a gap or a gap up or a gap lower. All we're concerned about is that engulfing pattern in this particular lesson. So even if we gapped higher, as long as we engulfed the range of the previous day, that's okay. But many times you won't see gaps in the Forex markets because of the 24-hour trading. But when you do see a gap, it usually happens when the market closed on Friday and then when it opened up again Sunday evening or Monday morning. Okay? Okay, Ruben asks, Stephen, as you can see yesterday, there were several engulfing and engulfing plus in the JPY pairs in D1. How do you solve this big SL in D1? You apply the SL in the right place or DI or go to the other time frame? Okay, I'm sorry. If you can kind of, first of all, remind me of the Japanese yen. As I don't recall exactly seeing it. I've been looking at probably about 100 markets this morning, so I don't recall exactly the yen. I know it's been going straight up. But as you can see, you said yesterday there were several engulfing and engulfing plus in the yen pairs. I can't really answer because I have to have a chart in front of me. So, probably the best thing, Ruben, would be for you to email me this to Brett M. at Specialist Trading. He'll forward it to me, and then I'll answer the question. Sorry, I just can't answer it now because I don't have the chart in front of me, and I can't really remember exactly everything you're looking at. Ray asks, do you have any other indicators to help trigger your entries and exits? Yes, we do, Ray. We have a number of proprietary indicators as well as standard indicators. Nothing advanced, though. For all of you who have attended my presentations in the past, you know that our benchmark for success is keep things as simple as possible. We are in no way a complicated type of educational company. We do not, have all these complicated indicators and complicated patterns. As you saw here, you saw how simple this engulfing pattern plus one was. This is probably one of the most complex patterns we have. Everything else is extremely simple. Most of our strategies have 5 rules or less. And so along with that, we have proprietary ways in which to trigger into entries and exits. The only trouble, once again, is this is reserved for our members. I can't give away that information, all of it, because a lot of that is for the paid members. So I invite you all to become, with that great discount, $345, I don't really know if you can get such a great performing strategy at such a low price. Once again, even though there are no guarantees, you would have paid for that course, had you purchased it last year, strategy number 5, about 20 times over with the money you could have made trading the signals that we provide for you. So there's different ways to trade it. You could have traded it more aggressively and probably gotten even better results. But in the past 2 years, strategy number 5 has had results of over 130%, just trading the signals we give you. And that's daily bars. That doesn't even include intraday bars or weekly bars or monthly bars. So it's a great, great tool. I just can't give you all the proprietary entry and exit techniques right now. Okay? I'm sorry. Then James asked, then how to spot when the same open and close? I'm not really sure I understand, James, when you spot with the same open and close. When you're saying when there's a doji, in other words, when there's a doji, if I understand your question correctly, if you're thinking is a doji, can that apply to a bearish engulfing pattern plus 1 or plus 5? Yes, it can. You just most likely, that's just within the pattern, and if that's what you're asking, yes, that counts as a day. That would be another engulfing pattern day. Okay. From John, who asks, what about gap on 5-minute charts? Well, once again, if there's a gap, if the gap still does not get in the way of any type of pattern on the engulfing, then don't worry about it. But if the gap does not give you an engulfing pattern, then there's no setup. So remember, we're not concerned with the gap. We're only concerned with finding this bearish or bullish engulfing pattern. If the gap totally takes out any type of pattern, then there's no pattern. That's all. Then you go on and look for another one. That's all. I mean, we're not concerned with trying to vary things for gaps or not. A gap is just comparable to either it's still being valid setup or not being a valid setup. Okay. Boyke asks, can the engulfing comprise of 2 candles? Can the engulfing comprise? No. Well, the engulfing pattern is two-bar pattern. So in other words, we want to only have, say, a bullish engulfing. We want to have a downward day followed by an upward day. But that's it. That's the basic engulfing pattern. Anything on top of that would be engulfing plus 1, plus 5, etc. But we only want the original pattern, which is an engulfing pattern, to be only 2 bars. The first bar, the initial bar, and then the second bar. Okay. Just have time for one question more, 1 or 2 at the most. Ray says, do you only look for these engulfing candles in overbought or oversold areas? No, it does not matter. We don't care, and we're not concerned with overbought or oversold. There's one thing that I've learned in my 36 years of trading is that, and I hope you really write this down or take this to heart, there is no such thing as overbought or oversold. Okay? I used to trying to trade overbought and oversold, and guess what? There's no such thing. It's a myth. Things, especially the Forex markets, they can go as high as they want, they can go as low as they want. If you try to trade overbought and oversold, it may work 9 times out of 10, but the 10th time it won't work, you'll give back everything. So don't worry about overbought, oversold. Just look for this pattern wherever it may be, okay? Nuno asks, after all, what's the most accurate TF to apply this technique? By TF, a time frame, I assume. I would say probably daily bars. Just try it with daily bars. But remember, this is education I'm giving you for free. Experiment. There's not one right thing that works for everyone. Some people swear by it on intraday time frame, on a 15-minute time frame. Other people say, I only look on daily bars. So it's really meant to fit your style. So experiment with it. The first thing is to paper trade and see how it works, and then you find and you decide what the best time frame is. That's one thing we teach at Specialist Trading. There is no one right thing that only works for everyone. We give you many variations so that you can make the strategy work to fit your style. You can trade it aggressively or conservatively. You can use the proprietary entry techniques to enter quickly or enter later. There's a lot of different ways to trade, okay? I guess that brings us to the end here. We're getting really close, and I don't want to take anyone else's time. I appreciate it. Remember, if you have any questions, be sure to email us at brettem@specialisttrading.com, or you can call us directly, 310-844-7220. You can go to find out more information by going to that link of the microsite that FX Street applied for us. You get a lot more information about us. Or, if you want, you can go to Pro Trader Strategies and you'll have more information on individual strategies as well. I thank you so much. Remember, next month I will give you part 2, which is another heightened candlestick chart for finding the trend direction. All right? Please use this freely, but remember, paper trade. Don't apply money to this because this is not a strategy. If you want to trade a strategy, please take advantage of the one we're offering through FX Street, or reduced it down to $345 for our strategy number 5. Thank you so much. Thank you so much to all the people at FX Street. Happy New Year, by the way, to everyone. And I look forward to 2013 being as successful as 2012 was. Thank you so much. We'll see you next time. Bye-bye.